All right, let's welcome back. Moving on from what we have discussed yesterday, we spoke about syllabus matters and we spoke about exam formats, and it's now time to start off by understanding an audit overview. So today my plan is to do audit overview and also to start off to give you an understanding of what is involved in an audit process. Okay, so moving further from that, I'll also cover audit risk. So, so my plan today is to cover audit overview and audit risk, and then from there you can actually attempt to do a question. Yeah, audit, I told you, is a practical paper, so it's good to always do as many questions as possible. All right, so let's start off. Let me give you an understanding about what is involved in an audit, but before that, let's understand what is an audit. All right, audit. We always mix this word audit and assurance, but let me clarify this to you that audit is the form of assurance. Right? It's the form of assurance. And then who needs this assurance? This assurance is given to third party. Right? Assurance is given to third party. Okay, so now who is this third party? Yeah, in a company, you have a company, right? This company consists of shareholders. Yeah, and then you have your management. Okay, now what has happened is shareholders have entrusted the company to the management. So when they have entrusted their wealth to the management, we say that management is doing the function of stewardship. Yeah, so you will realize that the basis of doing an audit is actually what? Management is doing stewardship for managing shareholders' funds, and then there comes the function of audit or the auditor to review this management, right? To review what is the responsibility of the management, right? Whether they have managed these funds, the investment, as per what has been committed to the shareholder. So understand the basis of audit. Yeah, many people misunderstand audit as something that is for finding fraud, is for detection of fraud. What is important to understand is audit is not finding fault or finding fraud. Yeah, audit is you are reviewing the responsibility and the accountability of management for their stewardship role that they have committed to the shareholders. Okay, so how many people are involved here? You have the management, you have the shareholder, and you have the auditor, so to say. Yeah, you have the audit or the auditor. Okay, that's why we say it's a three-party relationship. Yeah, so there is a three-party relationship. Now, what is the role of the auditor? The auditor is giving this shareholder an assurance, is providing. So this auditor is a practitioner providing assurance services to this shareholder. Assurance on what? Assurance on the management's responsibility. Okay, so many exam questions may ask you who's responsible for preparing company's financial statement. The responsibility for financial statement is the management's. Who's responsible to make sure that the company's internal controls, the which is there for detecting, preventing fraud, for preventing, detecting errors. Whose responsibility is that? It is also management's. It is not the auditor's responsibility. So please take note of that, that it is not the auditor's responsibility to do management's functions. Auditors are providing assurance that whether this management function responsibility have been conducted. So please understand, auditing is a form of assurance. Okay, how many people are involved? There is a three-party relationship between the management, the shareholder, and the so-called practitioner. Okay, that's why we say that auditing involves, I like to put an acronym to it. There's something called CREST. Yeah, along audit, I'll give you a lot of acronyms, because audit is a lot of things to remember. So good way to remember is to remember some of the acronyms. Yeah. C, I would like to say C is criteria. Right? What are these? These are the 5 components of actually assurance services. So this is 5 components of assurance services. So number 1, you must have a criteria. When you say whether a certain responsibility has been met, we must say that what is the criteria to say whether it has been met or not. What is the standard, right? So for example, in financial reporting responsibility, we know the standard is the International Financial Reporting Standards. So when we say it has met the standards, then we say, okay, then the responsibility for financial reporting is done. When we say the criteria is there is been zero fraud, right? There has been zero fraud. So that becomes the criteria. So there has to be some standards that we provide the assurance service. There has to be a standard. Otherwise, you will have confusion that according to the auditor that this is good enough, according to shareholder is not good enough. That means we need to have a common standard. Second is, after you have a standard, we're talking about financial reporting, then you have IFRS. We're talking about auditing, we have ISA. Yeah, so there is a standard, right? So there has to be a criteria. Then you have a report. It must result in a report. In auditing, you will result in a report. For example, this will be in the form of either an opinion or a report which highlights all the weaknesses and recommendation. It could be a weakness or recommendation. Yeah, it could be the audit report itself. Yeah, if you are an external auditor and you want to prepare an audit report, the audit report already has what is the opinion on the financial statements. Yeah, so that will be the audit report. It could be any form of report, due diligence report. Yeah, so that is a report. Then E, whenever the auditor presents the opinion, because we are professionals, we must not base it as a subjective opinion. According to me is this, according to me, him is that. It has to be substantiated with evidence. So everything about audit is about evidence. You don't have evidence, we cannot say anything, right? Even if you have committed a murder and there is no evidence, then we cannot prove anything. So evidence is the key. That's why evidence collection or audit evidence collection is one of the highlighted topics. Is one of the highlighted topics, questions that will be in your 20 marks question. Yeah, in your section B. So evidence. And then you have this is your audit evidence. Then you have subject matter. What are we auditing? We could be auditing many items. We could be auditing financial statements. We could be auditing internal controls. We could be auditing processes, process review. We could be doing due diligence. We could be reviewing, for example, forecast review, right? Or we may be doing any particular, the subject matter is a fraud that has recently happened. Yeah, subject matter could be anything. So this is the matter that is under analysis. Okay, now and then the T is the three-party relationship. Three-party relationship. Who are the three-party relationship? I like to summarize it with the acronym which may not sound so nice. RIP. Yeah, it is not rest in peace. It is R. It is responsible party. Responsible party. I is the intended user. Intended user. P is the practitioner. Practitioner. Yeah. So who is the responsible party? I have explained to you that responsible party is the management. Intended user is your shareholders or your investors, and practitioner is you. Yeah, is the auditor. Yeah. So you can add on to your list of your acronyms in FA. RIP. Yeah. So responsible party, intended user, and a practitioner. Okay. So you have 5 components of any assurance services. Yeah. Criteria, report, evidence, subject matter, and the three-party relationship. Okay. Now, moving on from now, you understand what is an assurance service and what was the background of having an assurance service is because of the involvement of this three-party relationship. Uh, now it's good to understand how many types of assurance services that we normally provide. Okay, so what are the assurance services that we can provide? Assurance, okay, we can have absolute assurance, absolute assurance. We have reasonable assurance, reasonable assurance, and then we have limited assurance, limited assurance. Okay. Now, how do we distinguish this? Absolute assurance is like giving a guarantee, that we guarantee that this is like this. In order to give absolute assurance, you will have to do 100% test, which in any of the assurance services we generally don't do. We don't do absolute assurance because this is like giving a guarantee. And please understand, auditors only come to the client only at a certain period, certain time of the year. So there is no way you can provide 100% assurance or 100% test. Yeah. So many times you see, oh, this is already a clean report from the auditor, meaning everything is okay. No, there is never 100% guarantee. Okay, but we can work on reasonable assurance, and we can work on reasonable assurance. Okay, now what do you mean by reasonable assurance is that reasonable assurance, yeah, reasonable assurance. What do you mean by reasonable assurance? That we can actively give our opinion. That in our opinion, okay, for example, if you're talking about financial statements, okay, you say that in our opinion, with reasonable assurance, we can provide you an assurance that the financial statements are free from material misstatements, all right, or the financial statements are true and fair. That is like giving a reasonable. So please remember, we always use the word that with reasonable assurance. Okay, so some firms use the word with reasonable assurance, or some firms use the word in all material aspects. All right, so in all material aspects. That the financial statements are free from financial statements, so free from misstatements. Okay, this is different from limited assurance. Okay, so what do you mean by reasonable assurance? That in all material aspects, material means significant items. So significantly, or in all material aspects, the financial statements, if financial statement is the subject matter, is free from misstatements. So example of this reasonable assurance is external financial statement audit. Because when we do financial statement audit, we are giving a reasonable assurance. Exactly what is external financial audit? So there's a subdivision here, external audit. This is the exact language we use. Providing independent opinion. The word is independent opinion. Okay, we are not giving any guarantee. This is my independent opinion in all material respects. In all material aspects or respects, financial statements are free from, normally we say in the class, financial statements are free from MM. What is MM? Material misstatement. Material misstatement. Okay, material misstatement could happen either due to fraud or error. There. So what are we doing? We are giving an opinion. Okay, and I'm giving opinion in all material respect, and I'm saying that is free from. So I am actually making a positive statement. So I have to positively affirm. That's why this is also like an attestation that I have to affirm that these financial statements are free from material misstatement. But this is my independent opinion. So it's the word material is so critical when we talk about external audit. The word independent is so critical. But please remember, the sentence is it's a positive statement, meaning I have to actually say whether I can give this positive statement or not. That's why when we give the audit report, when we are able to give this positive statement, we say that it is unmodified opinion, because we would like to give this opinion. But if we are able to give this opinion, we say okay, as per this positive opinion, we would like to give this positive opinion. We say it's unmodified opinion. But if we are not able to give this positive opinion, then we say that it's a modified opinion. So later when you learn about audit opinion or audit report, you will later realize that you will later see that there is something called unmodified, 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 or modified. Right? Later we learn about modification of the opinion. But understand what is the whole idea about. Yeah, it's you are giving opinion on financial statements. Please remember, this will become your subject matter. Okay. Now, moving on, moving on. What is then the limited assurance all about then? Now, so firstly, let me clarify this. So this is a positive statement. This is a positive assurance. It's a positive assurance, but when we give this positive assurance, we say that the subject matter in all material respects is free from misstatements. Okay, what is a positive assurance? Different from the next assurance service, which we call limited assurance services. Limited assurance services. This limited assurance, the service that is involved in here is whereby we do not use the word, we do not use positive statements. Instead, we say, for example, I've been given, let's say there was a report given to me, let's say a financial statement is given to me, but I'm not given enough time to actually check those financial statements. I do not have those, I cannot go to the client and go and do the, substantiate with the tracing, the vouching, all the evidence. So what I could do is I will say that I will only provide you limited assurance services, which means I will only do probably analytical review of the financial statements. For example, one of the investors want to take over another company. It's a merger situation, and I have been asked to review the due diligence, perform a due diligence services. So during a due diligence, you do not have access to all the supporting documents. All right, you cannot actually go to the client and actually check all. We cannot do that. We cannot provide reasonable assurance. We only have certain limited time. So because of the limited time and limited access to the data, yeah, limited time, limited access to the data, as a result, the assurance that we give is also limited. Now, so as a result, our report will only say that nothing, our report is nothing came to our attention, to our attention, which proved that the subject matter, the subject matter has misstatements. Can you see that? Can you see the difference? It's one positive assurance. We have to actually say that yes, in all material respects, this is free from misstatements. In other services, we say I'm not going to, affirm that this is not having any misstatements. I'm only going to say that when I checked it, nothing came to my attention which proved that this has any misstatement. So I'm not saying this is right, but I'm just saying that when I checked it, nothing came to my attention. So the level of assurance is there, but it is less than the reasonable assurance. Reasonable assurance, you actually are providing lot of additional evidence, supporting evidence. Limited assurance, you have evidence, but your evidence is your own analytical review. Yeah. So example of limited assurance services is due diligence review, uh, prospectus review, okay, Then you have, for example, forensic services, yeah, forensic audit. Um, if you have any, for example, any particular item, internal control review, internal control review. All this review is for me to just understand what can I conclude from this document that is given to me based on my analysis. Okay, it doesn't mean that I actually have full evidence to support my opinion. It just says that when I was checking it, nothing came to my attention. So I hope you understand the difference between uh, positive assurance, yeah, or reasonable assurance. Yeah, you see that? So reasonable assurance always results in a positive assurance. Limited assurance always has negative assurance. Yeah, positive assurance will say yes, it doesn't have any free, it's free from material misstatements, but I'm not giving you any guarantee. But limited assurance is that I'm not saying it's correct, but it nothing came to my attention. Okay, so that is the form of assurances that are normally done by the practitioners for assurance services. Okay, now moving on, moving on, I want to explain to you the overall external audit process, because in the coming chapters you'll be seeing a lot of things and you'll wonder what's happening, where am I, in which part, which stage of the audit am I in. Okay, so I want to give you an overall picture first. Okay. Okay, now when an auditor is approached by the client, by prospective clients, not everybody needs to be audited. There are some companies which are exempted from audit. In Indonesia, for example, if your revenue is below 50M, you are exempted. But if you are above 50M, or if you are a listed company, you need to be audited. Okay, so how does this process come along? Because we are in the field of this is a profession. Auditing is a professional, is in the professional context. So it's important to understand how is this appointment process, the whole process goes through. Okay, so this is how it actually starts. You have a company. Okay, so this company, right? The company will nominate. What is the first process? There is a nomination. Okay, this nomination is done by who? There's always a question. Who nominates? The nomination is within the company. When I say company, I'm talking about those charged with governance. It's important to understand the concept of governance, right? Who is charged with governance? Remember, when I say charged with governance, I'm talking about the stewardship function. The shareholder has charged who with governance to govern the company? Is the management. Who is inside that management? You have the BOD, you have the audit committee, right? Because BOD is assisted by audit committee. Later we go through about the roles of these guys. Let me give you an overall picture first. So these guys go and nominate who should be the auditor. They are nominating first. Please remember, nomination is different from approving who should be the auditor. This is just suggesting, right? Okay, we would like to nominate KPMG. We would like to nominate Ernst & Young. Okay, so there is this nomination process, and then when this nomination goes to the auditor, okay, so this auditor, what he does is he decides whether to accept accept nomination or decline. Accept nomination or decline nomination. Okay. Now, how will he decide? He has his uh, procedures before he can accept the nomination. Please note that nomination is not appointment. Yeah? Nomination is just being suggested. So even before being appointed, auditor needs to know, are you willing to be nominated? Okay, so auditor later we learn about what are the ethical consideration that the auditor needs to look into before accepting nomination. Yeah, because if your previous auditor has, like I said before, if your previous auditor has been asked to leave without any clear grounds, or the previous auditor left without any clear understanding, you will probably have the same problems that you have with this client, like the client had with the previous client. So it's important to know all the ethical issues that you will face. It's important to know whether the this company that I'm going to nominate, do I have enough resources? Maybe I'm going to be asked to nominate. I'm going to be asked to audit an oil company, and I have no experience in auditing oil company. So I need to look at my experience. I also need to look at the background of the directors that I'm going to work with. Are they having good reputation, or are they ex mafia? You don't know. So it's good for us to the auditors to know what to have certain procedures before even accepting nomination. Yeah. So let me just write down the bullet points for you. We'll go through this later. So he has to do any ethical consideration. He has to have any. He has to think about the resources, right? Resource consideration. He has to look at the director's background, and integrity, and then he needs to also have something called professional clearance, which means you need to contact the previous auditor to ask them what was the reason of, is there any significant reason why they should not accept this nomination. So they need to send a letter to the previous auditor to ask if is there any significant matters that the auditor need to know uh, for which they should not accept this nomination. So this is what we call professional clearance. Yeah, sending that letter to the previous auditor. So these are so after this accepting nomination, and he thinks about all this and accept the nomination. After he accepts the nomination, this is gone to the next stage, where it will go to the AGM of the company. In the AGM of the company, this nomination is presented to the shareholders. All right. So shareholders make a AGM resolution to appoint auditors. So if the question asks you who is the one who is appointing auditors, who are the auditors accountable to? The answer is not accountable to the company, to the BOD and the audit committee. No. The answer is, remember, your appointment comes from, who is the one appointing is the shareholders. Remember, these are the intended users. Okay, because through the AGM, the annual general meeting, the appointment of the auditors come. Yeah, so that's why there's a lot of trick questions in the exam. All right, are they responsible to the management, or are they responsible to the shareholders? It is to the shareholders. that we are responsible. So who can fire us? The one who can terminate us is also the shareholders. So as an auditors, you don't have to worry about what the management uh, threatens us. Let's say, it's important. The whole accountability process is to the shareholders, because you are on behalf of the shareholders. You are going to the management to review their stewardship role, because they were charged with governance. You get the picture? Yeah. Okay. So that is the picture of how this appointment process takes place. Okay. After this resolution of the appointment process takes place, then what is next? Okay. What is next is there is something called uh, yeah. Before he even starts, okay, he even starts to doing the audit, then he has to come up with the engagement letter. There has to be an engagement letter that has to be issued by the auditor. Okay, this is also known as preconditions. Preconditions for audit. Now, why do we need these preconditions for audit and in the form of an engagement letter? The idea is to minimize expectation gap. There is an expectation gap between who? Between the management and the auditor. Okay. Now, what is the expectation gap? Management expects auditors sometimes in the client, to do certain things which we are not responsible for. For example, when I was auditing, sometimes bank reconciliation statement was not ready yet. So client expect us to do the bank reconciliation, but it's important for them to know bank reconciliation is whose responsibility? It's the client's responsibility. They are the one responsible for financial statements, and they should be the one preparing bank reconciliation as well, because that's one of the internal controls to ensure the cash and the bank statement figures can be reconciled. Otherwise, there will be a suspicion of fraud or error. So, bank reconciliation should be prepared by the client, but sometimes the client expects us to do that. So it's important for us from the very beginning, before we start audit, we make things everything clear in the engagement letter, yeah, or in the terms of reference, yeah. So we need to clear. So it's important to here minimize expectation gap, and as a result, to confirm, this is to confirm that management accepts responsibility responsibility forward for number one, preparing financial statements. Number two, management accepts the responsibility for what? For internal controls. Management accepts the responsibility to give us full access to external auditors, because you don't want to go to client and you ask for any data, and then this guy says, oh sorry, we can't give you this is confidential. Yeah, you can't do that. Yeah, so you don't want to be in conflict with the management. So that's why we need to have these preconditions. How do we do that? We need an engagement letter which specifies clearly what is the I'll tell you shortly what is inside the engagement letter. Yeah, but the objective is to ensure that the management accept responsibility for preparing financial statements, internal control, giving us the full access to the external auditors, and also to confirm that are we talking about the same financial reporting framework. You if you go to client and they are using GAAP, and then you are auditing based on IFRS, and that's a mess. So it's important to also confirm the financial reporting framework. Can you see that? Okay, so you confirm the financial reporting framework, you confirm management's responsibility. How do we do that? We put a engagement letter. Okay, inside the engagement letter, we'll go through that later. What is inside that engagement letter? I want to give you a picture first. What's exactly happening? Okay, so once you have that engagement letter between the company's management and the auditor. So remember, yeah, engagement letter is between the company's management and the auditor. Appointment letter is from who? Is from shareholders to us. So different, yeah. Appointment letter and engagement letter are two different things. Appointment letter is shareholder to the auditor. Engagement letter is from the management to the auditor to minimize those expectation gap. Clear, yeah? Clear. Okay, now moving further, what happens after the engagement letter is done? So once the engagement letter is done, okay, engagement letter signed. After engagement letter is signed, we start the audit planning. Okay, now inside this audit planning, right, we need to come up with our audit strategy and audit plan. Later we go through each of these items. I want to give you what is the picture. Audit planning, we have audit strategy, and we have a audit plan, right? How do we do this audit planning? We are using the ISA 315, where we say that you are identifying risk of material misstatement through understanding of the business and its environment Okay, so that's why I told you we are doing risk-based audit, and this risk of material misstatement, how do we know? We need to understand the business. Yeah, so that's why we do research about the company, the nature of the business. Yeah, we need to do the past year financial statements. We need to look at anything on the website, on the any press release about the company, right? How have they been performing? Any significant events? So everything about the business, what regulation do they follow? Which industry they come under in? So we need to understand the business. From there, we will identify how is the impact on the financial statements. So it's important to know that when you are thinking about the audit planning, we are thinking about from the business risk that we see, we will then see what is the impact on financial statements. Okay, what will be the impact on the financial statements? What will be the impact on the financial statement? In other words, what will be your audit risk areas? That's why the highlighted part, remember the 30 marks question is about this, that you read the scenario and from this scenario you identified which are the areas which will probably it is a business risk, but how does it affect the financial statement, and then how does it create a risk. Yeah, I give you a quick example for you to understand a picture. Example, you feel you read in a scenario that the company is having significant going through a situation where there's an economy problem. The country that they are in is not doing so well. Okay, then that's a business risk. Okay, or the business is not doing good. For the past 3 years, for business is not doing good. So that's a business risk. Now, what is the impact of that business risk on the financial statements? Can you think about that? Now, if your business is not doing good, you will think that your inventory has been in the warehouse for a long time. It has not been moving probably. Now, if your inventory has not been moving for some time, then what will happen on the financial statement? You are probably having some inventory where you may have to later sell it below cost, or meaning sell it at a loss. You may have to sell some of your stock at loss. Now, if you're going to sell some of your stock at loss, meaning under your IAS 2, which says that inventory must be recorded at cost or NRV, lower of cost or NRV, meaning you need to know that there will be stock which I have to write down. So what is the audit risk? The audit risk is there is risk of overstated inventory. Can you see the nice approach that risk-based approach has, that we look at the business risk, and then we can identify which areas are affecting the financial statements, instead of doing it the old style. Old style was we go to a company and we do point blank, we have procedures in our hand, and then we check everything like blind people. We don't know what are we looking at, what are we searching. But by doing this, we know, oh, there is a risk. The risk is in the inventory, because there is a risk of overstated inventory. Why? Because this inventory is slow moving, and as a result, we need to write down the value of the inventory, because I may be selling this inventory at a loss. Can you see? We will see that a bit late, in the next sessions. But I want you to have a picture first, that this is part of audit planning, where you identify under ISA 315, you identify what we call ROMM, risk of material misstatement. Okay, after you identify risk, then you have audit strategy, which area to focus on, and then you create a audit plan, meaning what procedures you want to follow in order to collect evidence. Okay, then after you already have this audit planning done, what do you do then? After you do already audit plan, I will have to then move further. I need to plan when will be my interim audit, and I need to plan when will be my year-end audit. I also need to plan when will be my initial visit. Right? Okay. The initial visit is mostly for you to interview the director, to understand the business. Yeah, that is the initial visit. But during the interim audit, what are you doing? During the interim audit, you would like to do your system documentation, because you want to know how this company is processing all the information, the accounting information. Okay, so how's the process for purchasing? How's the process for sales? All those sales, purchase, payroll, non-current assets, cash and bank balances, receivables, payables. How is the process? So we would like to document those processes. Okay, So we want to document those processes, and we need to record that. Yeah, so we need to record. When we record that, later you learn about the idea of recording using narratives, using flow charts. Later, remind me to tell you about ICQ, internal control questionnaires, internal control questionnaires. Okay, I need to also have internal control evaluation questionnaires, ICEQ, ICEQ, internal control evaluation questionnaires, evaluation questionnaires, evaluation questionnaire. You also need to do something called walkthrough. Walkthrough. Walkthrough means what? Walkthrough means whatever you have seen in the system flow chart or the system process, you just have a quick look at the actual to see whether whatever is in the document is actually uh, actively done like that, because sometimes whatever is documented may not be in the actual process, because the staff may be actually following another updated process, you know. So walkthrough is not an audit. Walkthrough is simply to verify the existing process. Yeah, it is not to review the process. Yeah, it is simply to verify. Is to verify on the floor. Yeah, verify process on the floor. Okay, it is a walkthrough. So you do system documentation. You should do it. Sorry, this is not system documents. This is system documentation. System documentation. Okay. After you have a system documentation done, what do you do then? You do a system evaluation. System evaluation. This is where we bring in the idea of doing test of controls. Why? What is this test of control? Because you already know all the systems and all the controls that the company is implementing, and then you now want to see whether these controls are they effective. Are they effective? Test of control means what? You are making procedures to evaluate whether 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 controls are effective. Effective in what? Effective in preventing, detecting, correcting, preventing, detecting, correcting what? Correcting material misstatements. Material misstatements can happen due to what? Can you remember? Can happen due to either error or fraud. So along the way you will get used to this words, yeah? Material misstatements either due to error or fraud. So I want to test the controls. Are the controls actually being implemented? Are they effective? Are they able to prevent? Why do I want to do this? Normally, people who do procedural audit, they don't bother about doing tests of controls because they want to test everything. But remember, we are doing risk-based audit. Because we are doing risk-based audit, we want to see from whether the controls, if the controls are able to prevent and detect and correct misstatements, then we should focus on areas where there is a significant control deficiency, because that's where bigger error could have happened. Yeah, for example, if the in a company everybody can make purchases of any amounts, right? then there is a significant deficiency. But if the control of below $5,000 purchases is good enough, then we may not have to test those $5,000 below purchases. All right, we may have to test only the $5,000 above purchases because there may be a significant deficiency there. So now, why are we doing test of controls? We are not consultants. As an external auditors, we are not consultants to talk about that this is your control deficiency and what you're going to do about. The purpose of an external auditor to review the test of control is for this reason, and you need to know this for your multiple choice question. The purpose is to determine whether the how much will be the extent of substantive procedures. Okay. Now, what are the substantive procedures? Procedures to detect material misstatement. Okay. Test of control is what? Procedures to evaluate whether the controls are effective. Substantive procedure is procedure to detect material misstatement. That's where we have to do the testing of finding evidence for the particular account. So I need to decide how much of the substantive procedure I need to do. Should I do extensive, or should I do reduced? How will you decide? Obviously, logically, if your controls are excellent, then you don't have to do so many substantive procedures. You can reduce the level of your test, you can reduce the level of your sample size because the controls have been proven to be effective. You have done a test on it, you have tested the controls instead of testing the transactions. Can you see the difference? Test of controls, you're testing the controls are working on it, the signatures, the authorization is working on it. Yeah, whereas substantive is you're testing the transaction. Did the transaction actually take place? Was the value correct? Right? Yeah. So substantive procedure is you are procedures to detect material misstatement. You will decide based on your evaluation of your test of control. Okay. Now, once you decide the extent of your substantive procedures, how much you need to do, then this will result in all your, this together will give you all your, we'll go to the stage of audit evaluation, audit evidence gathering. Okay, so audit evidence gathering and audit evidence evaluation, that also comes under ISA. I don't want to confuse you with so many ISA numbers, but for you to know, it comes under ISA 500. Yeah, so after I already collected all the evidence, later I'll show you how to collect all the evidence. Yeah, there are collection techniques. So just to give you a picture, there is an inspection technique, right? There is a tracing technique. Tracing means what? From the source to the records. That is tracing, right? There is a vouching from the records to the source, for example. Then there is review of subsequent events review. There is also analytical review. Subsequent events is what? After the year end, if you find any events which are affecting the year end figures, for example, receivables, right? If you say that your receivable is $10,000, or $100,000, and then after in January, February, March, none of these receivables are actually paying, it means either you have irrecoverable debts which you should have written off, or you have actually made fake receivables. Can you see? So it's very interesting that you can actually find evidence about the past by looking at what happens after the event. Yeah, subsequent event or analytical review. You do a lot of ratio analysis to see whether the ratios are making sense or not. Yeah, so we'll go through that a bit later on, but understand that this results in audit evidence, and all this audit evidence collection must be documented in a current audit file. Yeah, we have this documentation inside your current audit file. Okay, after you collect your audit evidence, then we go to a stage of audit review. This review is done by the senior, by the manager level or the partner level, who reviews again all the audit evidence collected. He also sees what is the impact of all the misstatements that have been identified. He also looks at the misstatement review, right? He looks at all the materiality review. He also looks at whether there has been any consistency, right? Has there been any enough analytical review? Are the figures making sense? Okay. After this audit review process, then we start the report. Report results in two reports. One is your audit report itself, and the other one is your management letter. Okay. Now, management letter is the one that they expect you to inform those charged with governance in a letter for all the significant deficiencies that were identified during the audit. But please remember, that was not auditor's job. But whatever he has already found during the audit process, he must report it. Yeah. So all the significant deficiencies that he has found, and then what are his recommendations? Yeah. That's why this deficiencies and recommendation question is regularly there in your exam, because this is one of the reports that you need to actually present to your board of directors. Then audit report, you will have your the opinion, right? Then this one you will learn later that there is this unmodified and modified opinion, and what are the kinds of modified opinion. But I want you to have a full picture of what exactly is going through in the whole process. So you notice that there is this important process of this audit planning. Okay, then you have this system documentation, which happens during the interim audit. By the way, I forgot to tell you that all the audit evidence gathering is happening at the interim audit for the test of controls, but for the substantive test, mostly is happening at the year end. So substantive test happens at the year end and after the year end, of course, because at the year end you will do the inventory stock take review. Yeah, your inventory count review. Okay, and then after that you will have all your post year end review. So all the substantive tests happen at the year end and after the year end, right? Whereas test of controls and system documentation and system evaluation happens at the interim audit. Okay, so it's important to understand what happens then after the system documentation. The next stage is what? System evaluation. So you have so if I was to number it, this will be your first process, your A, audit planning. After audit planning is your, after your audit planning, you actually go and meet the director, and then you have your system documentation, and then you have your system evaluation. System evaluation, and then when you do the evaluation, you will do your test of controls, and then you decide how much of the substantive procedures you want to do, extensive or reduce. Yeah, so many exam question ask you, the purpose of test of control is to identify deficiencies. True or false? It's false. The purpose of identifying deficiency is, the purpose of reviewing internal controls is not to identify deficiencies for external auditors. Purpose for them, the purpose is to decide how much of substantive procedures I need to do, how much of detective procedures I need to do. That is the reason I want to look at controls, because by looking at controls, I can see how much I can rely on the controls and how much I need to do additional substantive procedure. So it allows me to decide how much of extensive uh, procedures I need to do, or can I reduce the substantive procedures. Okay. Then I will start collecting all the audit evidence which I need to file in the current audit file, and then after I finish it, I need to send it for review by the partner or the manager, and then the firm or the partner or the manager will prepare the report, which is the audit report and the management letter. Okay, so I think for now, it's good for you to understand this much first. In the next session, I will talk to you about audit risk in detail, and after that we want to do a question. Okay, thank you.